This is our Forex blog for November 7th, 2012. And like we do most days, we start with a currency meter. This is a part of our three-step easy Forex trading system, which if you want, you can actually even ignore now and just use our trading signals. However, I think it's always best to be in the currencies most likely to trend, continue trending, and also for the trades that work are much more likely to give you significantly bigger wins than your risk. The only secret to trading is having small losses, bigger wins. You want to be right more than you are wrong, and you want to have wins that are considerably bigger than your losses. So if you're going to lose $100, you want your wins to be 200 or 300, and that's it. That's the only secret to trading, and that's why I came up with the currency meter. This averages out multiple different time frames, statistical trends, and shows you one reading. I have also recently, within the last month, added the daily, weekly, monthly trend because new traders, as well as myself, find it easier to look at just one reading that factors in all the different time frames. The monthly trend only has 4% weighting, weekly trend 13%, daily trend 18%. And two-thirds of this is based on real-time, very, very fast 2- and 5-minute statistical trend strengths. How many dollar pairs, for instance, are going up or down right now based on multiple different statistical tools and models that we have. Also, we measure the intensity of those moves too. Is if during, let's say, a 5-minute period, the euro-dollar moves up or down 5 pips, and this bar moves up or down 10 pips during that 5-minute bar. Well, that's 100% extra intensity than what it normally has, and that reflects in here as well. So we will start by looking at the dollar as being very weak earlier in the day. You can see the CAD was very strong, the Australian very strong, and the New Zealand very strong. So you want to sell the dollar CAD, you want to buy the Australian dollar, and you want to look for buys in the New Zealand dollar. It's that simple. Starting off the day, we're looking for sells. Keep in mind that this currency is already near our lower 2.0 white band. Typically, currencies tend to reverse at or underneath there, and we have our 3.0 band, which really is about a 90% chance within an hour you're going to get a reversal from that area. So our first sell, you can see, fell about 15 pips. And anytime you see signals right near the lower 2.0 band, you might want to be a little bit more cautious. This one, anytime you get a sell signal, then the next one is usually a little higher probability. This one's retraced up enough, you would have had a small loss on that one, 10 pips. This one retraces right to the previous day's low, very high probability, sell signal, it goes down 10 pips. And once the currency goes from underneath to above the hourly moving average, typically the trend, and you can clearly see it on our tools right here, the trend is no longer down. So using the currency meter, you wanted to sell the dollar CAD, but really after about 4 right here, that trend's no longer down. And later in the day, you can see the dollar was really strong, the CAD was very weak, and later in the day you want to do the exact opposite, look for buys. This thing just exploded. You're looking for buy trades, and even if you don't want to take or see signals on a chart, because these are based on chart patterns, you can draw trend lines over pullback areas, or if you see it go sideways for half an hour to 2 hours, buy those breakouts. It does become progressively riskier to buy above the white band. And I would never recommend buying above the green band. In fact, I scaled into a counter trend trade with my average position somewhere around 74 during this time. And it really took about almost an hour to come back down. For me to get out of this trade, I got out somewhere down here near 60, 62 or 3 was my exit. But nonetheless, these bands, when the market is above the 3.0 band and it's gone to the next fib level, you draw your fibs on here, you can really look to get in and scale into positions between the first and second fib target. And typically what I do is if I see it going up with this much strength, I'm going to wait for the first red bar right here. There was a huge sell, counter trend sell signal up here. If you click on it, it says above daily 2 standard deviation high. This thing's just gone up too much. There's a 95% chance it's going to pull back, 15, 25 pips. So That's one of the reasons I got short myself in this one. And I really expected it, once I was short, to pull back a little bit faster and farther than it did, so I got out with a much smaller profit than I would normally look for. Typically, if you see a big move like this, it's going to pull back 38% eventually. So I would, if I was going to hold this longer, or if it hadn't gone up with such incredible intensity, I would put a alert right near this fib level. And one of my secrets is I will do my analysis, draw trend lines on the chart, and I'll get alerted when they get broken. I will draw fibs on the chart and draw, as you saw, regular lines next to a fib area. Right-click on it and create an alert, and it will send a cell phone message to my phone and play an audio message if I want as well. And typically, I don't watch the charts, tick by tick. I do, but I don't every single day. Typically, I'll just put buy and sell areas that I want to buy at, and then I will use our signals in combination with that. And that way, especially once you're outside of the normal trading times of the day, most of the time the fib areas never get hit. Today, a ton of them got hit. I was buying the euro dollar, euro yen at extreme lows, and I sold this dollar CAD too. It was an excellent day for counter trend trading at the extremes. And that's why we have these statistical trend tools as well. All right, so getting back to the charts, we have the Australian that we wanted to buy against the dollar and the yen earlier in the day. So earlier in the day, this is kind of going sideways. You have a nice little kind of wedge pattern right there where it breaks out, and typically whenever you see that, you can expect it to go to the fib target of the next level up, which it does. It goes right to the 1.618. It's right near our upper bands. This thing's strong statistically, but it's not pegged at 100. Anytime you see a 100 one, like you saw in the dollar CAD, those can keep running and running. You can see it hitting 100 here, 100 here for a couple bars earlier, and the move up it hit 100. Hundreds don't happen that often. Pretty much all the time frames are lined up whenever that happens. So this one's strong, but it's not incredibly strong. You would have got in here at 60. Probably got out of half your trade at the first fib target and the other half at the second one. And when the market's gone up a lot, typically wait for a two-wave pullback. You might have gotten long right here, and you wouldn't have made much on that next move. But you can see, going back to the currency meter, that really the dollar lost its extreme weakness after 4. Now that doesn't mean you can't continue to look for buys in the Australian yen. Alright, so earlier in the day we have a strong trend. It's right at the previous week's high. It's going sideways right there and breaks out. This is a very high probability trade. Our currency meter had you watching for this, and you can see it went up close to 30 pips. Again, notice where it stopped, right at our upper bands. And that's why we use these statistical bands, because they warn us that the trend might reverse. Also notice earlier in the previous move up, incredible 100 strength. This next move up had less strength. Up until about 4, the yen was strong, and then it all of a sudden lost its strength, which you can see here. It fell with a lot of intensity. Then you had a 3-bar up move with almost no strength. This is a very high probability trade. And our signals, by the way, do not use our real-time momentum tool. If you were to just bring this chart up, you would only see this for the rightmost bar. It only works live because it uses multiple time frames. It's impossible to line it up after the fact. That being said, though, by watching this, some of the best trades are when you see a down move with incredible weakness, 80 or plus, and then a 3 to 4 bar up move with almost no strength at all. This is one of the highest probability trades. Now, obviously, our signals are looking for key areas like the hourly moving average. 3-bar down move to the value area typically is going to get a 10 to 15 pip bounce. This one was so weak that it didn't. And again, these signals on the chart are not using this build your own trend. So if you see a buy signal and there's incredible weakness, skip it. And also look for very no-brainer patterns like this. Down move, up, a lot more intensity to down than up. And you can see the same thing here. Sell signal here, incredible weakness down. It went up right here with a little bit of strength. The next wave up had, half the strength was before. You got short right here, and you can see it ultimately fell 10, 20, 30, 40, 50 pips. You always want to draw your fibs on the last wave, and most of the time the first fib target is going to be a good place to get out of this trade. So it's somewhere around 24. Myself personally, when it went down here and went sideways, I would have probably got out of half, and I would have got out of the other half here at 33 and not caught that last 15 pips. Typically, I don't be I try not to get greedy. Now, the Australian yen right here later in the day was weak. This is a 4 pips per bar chart. Another thing you do if you want to scalp currencies, just simply bring up a range chart, and let's put in here. Put in 3 pips per bar. This is a wonderful way of scalping because, if you're wrong, you're going to lose 3 pips plus 1 pip padding plus the spread. So it's typically very small, and you can trade small number of lots, and if you're wrong, trade a little bit more lots on the next trade. So for example, let's say when this was starting to go down at this point right here, you're looking to sell. We're going to talk about trades I would take myself. Anytime you see an up-down pattern like this where it can't take out the highs and breaks down, it's a pretty decent trade. So you're short right here at 45, it comes down. I'm not going to be greedy, and I'm also going to know where my fib targets are for this last little wave. And so I'm just talking on a pure scalping basis, short at 45 out here. So you might have, after the spread, if you were one of the ECM brokers that we use, you might have made 6 or 7 pips here. All right, so we got a little bit of a pullback up. I'm not going to sell this right here because I'm going to look for at least a 4-bar up move, 1, 2, 3, 4, and I like to see wicks at the high. So I personally would not have taken this one, but I would have taken this one. So move this thing over here. And all we're doing is going short when it goes 1 pip underneath that first down bar's low, putting our stop above the high, and drawing your fibs off this last little wave. And if it stops at the first fib target, you're out. If it goes to the second one, typically I'll wait. And sometimes it goes past that and goes to the 2.0. Rarely does it go beyond that. Now, our new fib tool, when you draw it, it shows you how many pips that are on the swing. This is only a 16 pip swing. So these fib levels are not as accurate. I like to see at least 25 pip moves. And here you go. You can see it went to the 1.382, which happened to just line up with the 1.618 with a smaller move. So this is a very high probability place. You're short right here at 34. You're out at 16. You probably made 15 pips on that trade, right? So this is probably not a trade I would take, but let's say I went short right here. Well, guess what? By using 3 pips bar and trading the very weak ones, and I'm going to scroll over to the right. Anytime the currency goes your way, then comes back immediately within a bar or two back above where you got short, I'll move my stop down a little bit. And so a lot of times on these things, let's just say for example's sake, I did 1 lot here. So I will have a 3 or 4 pip loss, right? So we'll wait for it to go up a little bit. 1, 2, 3, 4 bars, 5 bars, reversal. Let's get rid of these other things. Actually, get rid of all of them. And so if I did 1 lot here, and let's just say I lost $50 or $60, I'm going to short it again here with the stop above the high. And you only want to be doing this in one of the weakest currencies. Later in the day today, the Australian was weak and the yen was stronger. You saw it here on the currency meter. The build your own trend momentum. So you're short, and it reversed again. This one unfortunately came right back up where I would have put the stop, so I'm expecting it to go down, or I'm going to move my stop down. All right, because it took a while to go, I'm going to move my stop down. All right, I'm going to move my stop here. We're already at break even. And a lot of times you don't know if it's going to go back down. It might go back down to the low and be a double bottom. So 15 is a potential profit target. It might also retrace halfway of this move. This is only a 23 pip move, 26 might be an area. I might exit half my trade there if it does stall here. If it goes through that, I want to see 23 area, shot through that. I'm going to get out of half my trade here because we're scalping. Some trades are going to be 20, 30 pip wins, and other ones are going to, we're going to take, whatever we can get, whether even if it's 5, 6 pips. Still in the other half. I'm moving my stop down now above these high. Alright, so I would be out somewhere around 23 on the other half. It could continue on down without me, but you can see it's also pulled back up 5 pips, or 5 bars. We can go short again right here. Moving the stop pretty much near break even already. Alright, so I'd be out of the whole trade right here. But that's how you can scalp using very, very tiny 3 pips per bar range charts. They're just very clean. And one of the patterns I like is waiting for a pullback, retracement, into counter trend trade against the trend that's down, and then a few bars up down where traders are fighting it out. Some are trying to buy and trying to push it higher, others are selling. And when it finally does break down, the people that were trying to buy there are stuck in a losing position, and that's going to add fuel to the fire. The trend is down, and you're trading with the trend only when you're doing this kind of scalping mode.